Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Teva Pharmaceutical.
If you find our talks useful, please consider subscribe, like, and comment underneath. So today we are stepping back to analyze a really massive structural shift happening right now in the pharmaceutical space.
Yeah, it's a classic corporate transformation story.
Right, exactly. The kind of pivot that business schools eventually turn into case studies. We are talking about a legacy generic drug manufacturer moving aggressively away from its roots to become a high-margin, branded pharmaceutical powerhouse.
It is a textbook turnaround story.
Uh-huh.
And for those of you listening who want to understand the actual mechanics of wealth creation, this is exactly the kind of situation that warrants your attention.
We're going to unpack the wealth-building context behind the stock for you today.
Right, which means breaking down the underlying fundamentals, the clinical pipeline, and the specific catalysts approaching over the next 6 to 12 months.
It's not just a review of past performance.
No, not at all. It's an examination of the corporate machinery designed to drive future valuation.
Let's start with the foundation of that transformation, because moving from a volume-based generics business to a brand-driven model is, well, it's incredibly difficult to execute.
Very difficult.
Looking at the 2025 revenue numbers, they brought in $17.3 billion. That's about a 4% year-over-year top-line growth, marking their third consecutive year of expansion.
Which is solid.
It is, but on the surface, 4% top-line growth doesn't exactly sound like a screaming growth narrative. It sounds steady, maybe even a little stagnant. So what is the underlying insight here that the headline number is missing?
So instead of focusing on that 4% overall growth, the real aha moment for you here is the internal replacement cycle. You really have to understand the historical context of the generic drug market.
It's brutal.
It's essentially a race to the bottom. Generics are a volume game defined by patent expirations, fierce price wars with overseas manufacturers, and just razor-thin profit margins.
Right.
What this company is doing is deliberately letting those cheap, low-margin generic revenues taper off. And they are replacing them dollar for dollar with premium branded drugs.
Which is where the real money is.
Exactly. In fact, in the fourth quarter of 2025 alone, their innovative branded products generated over $1 billion in cumulative revenue. That is a profound change in the quality of their earnings.
It's kind of like a company that used to make pennies selling bulk, unbranded coffee beans suddenly pivoting to opening high-end boutique cafes.
That's a great way to look at it.
The sheer volume of product moving out the door might look lower, but the profit retained on every single transaction is astronomically higher.
That is a perfect analogy. And you can see this dynamic playing out clearly when you look at the big three standout drugs driving this transition. First, you have Austedo.
Which is for severe movement disorders.
Yes. That drug captured $2.26 billion in global revenues, representing a 34% year-over-year increase. Then there's Ajovy, their migraine treatment, which secured $673 million in sales.
Up 30%, I believe?
Right, up 30%. And finally, Uzedy, their treatment for schizophrenia, sits at $191 million in sales, but is accelerating at a remarkable 63%.
Those growth rates are genuinely impressive. But to play the skeptic for a second, what's to stop another manufacturer from simply coming in and undercutting them? Like exactly what happens in the generic space they're trying to leave.
Well, that is where the concept of the competitive moat comes into play. When you build a branded drug portfolio for highly complex neurological conditions like schizophrenia or Huntington's disease, you create extremely high switching costs.
Because it's so hard to get a patient stabilized.
Exactly. Think about the clinical reality for a physician or a patient here. Titrating psychiatric or neurological medication is a delicate, often frustrating process. If you have a patient whose schizophrenia or chronic migraines are finally stabilized on a specific branded medication, a doctor is highly unlikely to switch them to a competitor's drug just to save the insurance company a few dollars.
The risk of patient relapse is just way too high.
Precisely. This clinical reality insulates their revenue streams from the very same cutthroat competition they used to rely on.
So they have essentially built a fortress around these specific therapeutic areas, and that insulation is showing up directly in their profitability metrics. Looking at their Q4 2025 earnings, they posted an adjusted earnings per share of 96 cents.
Beating consensus by quite a bit.
Yeah, beat Wall Street's consensus by 32 cents. And for the full year of 2025, they delivered a net profit of $3.4 billion, which is a 19.3% increase year over year.
Huge jump.
It is. But again, to play the skeptic, how exactly is a company growing its net profit by nearly 20% when its top-line revenue only grew by 4%?
This brings us to a financial mechanism that is absolutely crucial for you to understand when evaluating turnaround stories. Operational leverage. Their non-GAAP gross profit margins jumped to 60.3%, up from 54.8% the prior year.
That's a massive expansion.
It gets better. Their operating margins expanded by 470 basis points, reaching 32.5%.
Let's break that down for a second, because 470 basis points is a substantial metric. In plain English, that's a 4.7% jump in profitability on their core operations. For a company doing over $17 billion in sales, finding an extra 4.7% in operational efficiency is incredibly difficult.
It is, and it speaks directly to the success of that boutique cafe analogy you used earlier. Operational leverage means that as they scale up these high-margin branded products, every new dollar of revenue that flows through the business brings a significantly larger percentage of profit with it than the previous dollar did.
Because the fixed costs are already covered.
Exactly. The fixed costs of running their global operations are already baked in. So as Austedo or Ajuvi sales grow, that new revenue falls almost entirely to the bottom line. They aren't just selling more medication, they are retaining a much larger cut of everything they sell. That is the hallmark of a legacy business successfully executing a higher margin product mix.
That high switching cost and operational leverage certainly protect their present, but Wall Street is a forward-looking mechanism. A stock's valuation is rarely about what a company did yesterday. It's about what is sitting in the pipeline right now.
And their future relies heavily on advancing new assets, which brings us to a potential $10 billion upside scenario.
Let's get into that, because $10 billion is a staggering number.
This is where the narrative shifts from a story of steady margin improvement to a story of substantial long-term growth. The CEO, Richard Francis, recently issued a very bold projection. He stated that the company anticipates late-stage clinical trial results in immunology and neurology in 2026 that could generate $10 billion in potential future sales.
And the absolute crown jewel of that projection is a pipeline asset called duvakitug.
Right, duvakitug.
It's currently advancing through phase 3 trials for both ulcerative colitis and Crohn's disease. And it is worth noting for the listener that this isn't just a shot in the dark. We already saw really strong clinical efficacy in their February 2026 phase 2b maintenance data.
The addressable market for inflammatory bowel diseases is enormous. These are chronic, debilitating conditions, and the current standard of care leaves a lot of patients underserved. Biologics and immunology drugs in this space command premium pricing because they're incredibly complex to manufacture and they deliver life-altering results.
So if duvakitug successfully navigates phase 3, it positions them to capture a massive share of a multi-billion-dollar global market.
Exactly.
But CEO projections are one thing. Executives are literally paid to be optimistic. What gives this $10 billion projection actual weight is that we're seeing serious validation from institutional players, the smart money.
Yes, the recent capital infusions.
Right, 2 massive recent capital infusions that act as massive votes of confidence. First, they secured a $500 million milestone payment from Sanofi, which is directly tied to the clinical progress of duvakitug. And then, on March 3, 2026, they announced a $400 million funding agreement from Blackstone Life Sciences.
Those 2 deals are critical to the investment thesis, especially the Blackstone agreement. Let's translate the mechanics of that deal so you can see exactly why it's such a bullish signal. The Blackstone agreement provides what is known as non-dilutive capital over a 4-year period.
Non-dilutive being the key word there.
Crucial word. In the biotechnology sector, running global phase 3 clinical trials is notoriously expensive. We're talking hundreds of millions of dollars in research, patient monitoring, and regulatory compliance. Typically, to fund that final push, a company has to issue secondary stock offerings,
which dilutes the equity pool and actively punishes existing shareholders who believed in the turnaround early on.
Precisely. But with non-dilutive capital, Blackstone is essentially stepping in to function as project financing. They are footing the bill for the clinical trials without the company having to print a single new share. You have to consider the due diligence involved here.
Blackstone isn't just handing over $400 million for fun.
No. Blackstone's scientific advisors have scrutinized the phase 2b data for duvakitug and calculated that the probability of success is worth a $400 million wager. It entirely removes the balance sheet risk for the company, ensuring the drug reaches the finish line without straining current cash flows.
That is a highly strategic way to finance innovation. And while duvakitug is the headline grabber, there are other revenue streams quietly moving toward commercialization. Like in late February 2026, the FDA accepted their application for TEV 749.
The monthly injectable treatment for schizophrenia.
Exactly.
This asset is a perfect example of solving a real-world clinical problem. Schizophrenia affects roughly 1.1% of the U.S. population. It is a large addressable market, estimated globally at around $8 billion. However, the primary hurdle in treating severe psychiatric conditions is medication adherence.
It's really tough to get patients to take a pill every single day.
Very difficult. Expecting a patient who is struggling with profound mental illness to take a daily oral pill without fail is often unrealistic. A monthly injectable fundamentally solves that compliance issue. It provides a steady, reliable therapy for the patient, reducing hospitalization rates. And from a business perspective, it locks in a highly predictable, recurring revenue stream.
Okay, so we have a solid foundation of margin expansion, a pipeline validated by institutional capital, and new products entering the regulatory queue. Let's move into the technicals, the market sentiment, and most importantly, the bear case.
The bear case is essential here.
Because right now, the market seems to be sitting in a prove-it phase. Following those impressive Q4 earnings, the stock was trading around $32.55 pre-market. Now, if we zoom out, the equity has actually doubled since Q3 2024, which is a phenomenal run. But recently, we've seen a 3 to 5% pullback.
And the hesitation causing that pullback comes directly from their 2026 forward guidance.
Yeah.
Management projected 2026 revenue to land between $16.4 and $16.8 billion. Right. If you recall the 2025 revenue we discussed earlier, the $17.3 billion, that guidance implies flat or potentially even negative growth for the current year. Wall Street algorithms and short-term fund managers despise flat guidance.
But management has been highly transparent about this, haven't they?
They have. They are explicitly calling 2026 a trough year. It is a transitional period where legacy generic revenues continue to bleed off before the broader growth across their branded pipeline accelerates in 2027.
But hold on, if you're an investor looking at 2026 and the company itself is telling you that revenue is going to be flat or down, why step in now? Why wouldn't Wall Street just sit on their hands, earn a guaranteed 5% on money market fund, and wait until December to buy the stock right before the 2027 acceleration?
That is the exact psychological friction creating the current consolidation. Retail investors might wait, but institutional analysts are not waiting around. The market is a discounting mechanism. If you wait until December, the 2027 growth will already be priced in. We are seeing major bullish signals from the big players precisely because they are positioning themselves ahead of the curve.
Like Piper Sandler.
Exactly. On March 4th, Piper Sandler issued an upgrade, raising their price target to $41. That implies a 26% upside from current levels. Furthermore, Bank of America maintained a buy rating, specifically highlighting the potential for multiple expansion.
Let's define that for the listener quickly, because multiple expansion is a term thrown around on financial networks constantly. Bank of America noted the stock is currently trading at an enterprise value to 2026 EBITDA multiple of about 10.
Right. For you listening, think of the EV to EBITDA multiple as the company's total price tag, including its debt, compared to its core cash profit. A multiple of 10 in the biotechnology and pharmaceutical world is often viewed as quite cheap.
Especially for a company boasting 60% gross margins.
And holding a pipeline asset potentially worth $10 billion. Bank of America is suggesting that as the market gains confidence in the 2027 growth story, investors will be willing to pay a higher premium for the same amount of profit. If that multiple expands from 10 to, say, 12 or 13, the stock price appreciates significantly even if the underlying earnings remain steady.
And we are seeing sustained institutional accumulation reflecting this exact thesis. Heavy hitters like the Barron Healthcare Fund and the Allspring SMID-Cap Growth Fund are actively buying the recent dip.
They are.
So that institutional backing provides a strong floor. But any objective analysis requires looking at the downside just as closely. What could disrupt this thesis? Let's walk through the specific risk assessment, the bear case.
Critical thinking means acknowledging that no investment is without structural risk. There are three primary headwinds you need to monitor. First is the guidance miss risk. Yes, management has set expectations low by calling 2026 a trough year, but if the sales of their innovative branded products decelerate faster than anticipated, or if their remaining generic drug revenues fall off a steeper cliff than modeled,
they could miss even that conservative $16.4 billion floor.
Exactly. If they break that guidance, the market will penalize them, and you can easily see a 10 to 15% technical pullback.
Which would trigger a sharp repricing, especially for anyone who bought near the top of the recent multi-month rally. What's the second major risk?
The second risk is clinical failure. This is the binary risk inherent to any pharmaceutical investment. The $10 billion upside thesis relies heavily on duvakitug succeeding in its phase 3 trials for inflammatory bowel diseases.
And if it fails?
If that trial fails to meet its primary endpoints, or if it encounters significant safety signals resulting in regulatory delays, that entire future revenue model evaporates overnight. The market would reprice the stock immediately to reflect the loss of that future cash flow, potentially triggering a severe 20 to 25% correction. Now, the Sanofi and Blackstone partnerships mitigate the direct financial sting to the balance sheet, but the valuation hit to the equity would still be considerable.
Makes sense. And what about the macroeconomic environment? I've seen several financial headlines recently pointing to pharma sector weakness tied specifically to geopolitical tensions, specifically the ongoing Middle East conflict. Teva Pharmaceutical is an Israeli-domiciled company. How much does that regional instability actually impact the structural investment thesis?
It's a valid concern, and something the broader market is actively digesting. We need to evaluate this strictly through the lens of factual financial implications. The reality is that the Middle East conflict creates a sector-wide headwind. Because the corporate headquarters is domiciled in Israel, there is a perception risk.
Right, algos just scan the headlines and sell.
Precisely. When geopolitical tensions escalate, headline-driven trading algorithms will often blindly sell associated equities to reduce regional exposure. However, if you examine their actual fundamentals, their revenue base is globally diversified. Furthermore, their manufacturing and operational footprints, especially for these key high-margin branded products, are heavily anchored in the United States and Europe. The direct operational exposure to the regional conflict is mathematically quite mitigated.
That is a critical distinction for anyone analyzing this space. It's about separating the structural, operational realities of a business from the algorithmic volatility triggered by global headlines. You have to know what you own and where the actual revenue is generated. So, taking all of this into account, let's tie it together. Let's look at the catalyst calendar and the actual trade structure over the next 3 months, heading into the spring and summer of 2026.
The upcoming quarter is packed with actionable events. Looking at Q2 2026, we are anticipating the interim data for the duvakitug phase 3 trials, likely landing in that April to May window. That data release will be a major binary event for the stock. We also have Q1 earnings approaching in late April, which will provide our first tangible look at how management is navigating this trough year and whether the branded drug sales are holding their momentum.
Beyond earnings and trial data, there's also the commercial launch ramp for TV749, the schizophrenia injectable we discussed, and perhaps most importantly for long-term sentiment. There is an investor day expected in May.
That investor day will be critical.
Yeah, because executive leadership is going to have to stand in front of Wall Street and clearly articulate the specific mechanics of the 2027 growth acceleration thesis. They have to prove that the trough year is a temporary bridge, not a permanent plateau.
Exactly. When you synthesize all these components, the fundamental pivot from generics to brands, the institutional validation of the pipeline, the current valuation multiples, and the acknowledged risks, we arrive at our final wealth-building framework. Based on this analysis, the setup earns an 8.5 out of 10 bullish score.
Wow, 8.5 out of 10.
Yes, the optimal strategy here is not a short-term day trade. It is structured as a 6 to 12-month multi-catalyst hold.
An 8.5 out of 10 suggests a really strong conviction in the turnaround. What does the specific pricing structure look like for that 6 to 12-month horizon?
For the near term, meaning the next 3 months surrounding the Q1 earnings and interim trial data, the target price sits at 41 partners. This aligns with the recent upgrades from Piper Sandler and reflects a standard multiple expansion as the market digests the Blackstone partnership. Moving into the medium term, the 6 to 12-month window, the target expands to a range of $48 to $52.
And what specific macroeconomic conditions are required to hit that upper $52 target?
That higher valuation assumes two things. First, that we see a broader easing of Federal Reserve interest rates, which generally boosts valuations across the entire biotechnology sector by lowering the cost of capital. Second, it assumes that the 2027 catalysts, specifically the successful advancement of duvakitug, prove viable. If those conditions are met, we could see that EV to EBITDA multiple expand from its current base of 10 up to 12 or even 14 times.
But as we discussed, there are genuine risks. How do you protect the downside while waiting for those catalysts to materialize?
You protect your capital by implementing a strict stop loss at 28 tires. That level is roughly 10% below current pre-market pricing. Setting the stop loss there makes clear technical sense.
Because it protects the trend line.
Right. If the stock breaks below $28, It decisively fractures the multi-quarter uptrend that has been intact since Q3 of 2024. If that structural trend breaks, whether due to a clinical failure or a severe earnings miss, the thesis is invalidated. You step aside, preserve your capital, and reassess the landscape. But until that technical floor is breached, the asymmetric risk-reward profile presented by this corporate turnaround is highly compelling.
It really is a fascinating study of a legacy company refusing to just slowly fade into obsolescence, and instead choosing to completely reinvent its operational DNA in real time. The transition from a low-margin volume game to a high-margin innovation engine is fraught with risk, but as we've seen today, the financial rewards for executing that pivot are substantial.
It is a remarkable pivot, and I want to leave you with a final thought to mull over as you review your own portfolio holdings this week. We have just spent the last 20 minutes analyzing how Teva Pharmaceutical is successfully rewriting its corporate identity to survive and thrive in a modern, brand-driven market.
The ultimate turnaround.
Exactly. It makes you wonder, if a legacy generic manufacturer can navigate this complex transition to become an innovative, high-margin biotech giant, what other overlooked, seemingly stagnant legacy companies in your own portfolio might be quietly partnering with institutional capital to build a $10 billion secret weapon right now?
That is an excellent framework for evaluating long-term value in the markets. Keep looking beneath the surface of those legacy holdings for hidden transformations, and we will see you next time.